Ladies and gentlemen, friends of the channel, today I'm going to do something rare. I'm going to admit that my earlier view on precious metals, specifically gold and silver, was incomplete. I believed gold and silver would essentially move in lockstep as dual safe havens, a sort of metal pair for protection and growth. That's not how it turned out. When I first evaluated the role of precious metals, I approached them through a traditional lens as static safe havens, disconnected from innovation or macroevolution. I thought their performance would simply mirror inflation or fear cycles, that investors would retreat to gold and silver when uncertainty rose, and that those cycles would be linear and predictable. But the reality turned out to be far more nuanced, shaped by a structural transformation in global capital flows, technology, and the behavior of central banks. My assumptions were built on an outdated map, while the terrain beneath us was quietly shifting. Gold and silver are not just commodities. They are psychological and geopolitical assets, reflections of global trust and systemic transition. I used to think that their moves were reactions to inflation expectations alone. Yet, what we've witnessed over the past few years proves that these metals have become proxies for deeper forces, the restructuring of global reserves, the erosion of fiat credibility, and the emergence of decentralized alternatives. Gold's resilience, for example, has less to do with consumer fear and more to do with the deliberate repositioning of central banks diversifying away from the U.S. dollar. Over 1,000 tons of gold were purchased by official institutions in 2023 and 2024, the highest in modern history. That's not emotional trading, that's strategic reallocation at the core of the monetary system. Meanwhile, silver was supposed to mirror gold's strength. Historically, it moved in tandem, a cheaper, more volatile cousin that caught up in every bull run. But this time, silver's trajectory diverged. Industrial demand began to dominate its behavior. Photovoltaic growth in solar, electronics, and electric vehicles consumed record tonnage of silver, while investment demand lagged. What I misread was the dual identity of silver, part monetary hedge, part industrial metal. This duality means silver reacts differently to inflation, rates, and growth. When the economy expands, its industrial demand strengthens. When it contracts, its speculative side collapses. The interplay creates cycles that defy traditional safe haven expectations. My initial view also underestimated how financial innovation would reshape the way investors access these metals. Tokenized gold, blockchain-based ETF, and fractionalized ownership have democratized access to gold and silver, changing the demand structure. They are no longer just stored in vaults or coins. They are now programmable, portable, liquid digital assets. This structural shift amplifies their market reach while decoupling them from the historical limitations of physical settlement, yet it also means price behavior is increasingly driven by liquidity, not just scarcity, a fundamental shift from the past. I also assumed that rising interest rates would inevitably suppress both metals, since higher yields typically compete with non-yielding assets. But the global economy has entered a phase where debt saturation and fiscal dominance limit how far real yields can rise before financial stress emerges. In that environment, gold, especially, becomes an alternative not to cash, but to the credibility of monetary policy itself. That realization reframed my perspective entirely. Gold is not reacting to inflation. It's reacting to policy instability. Silver, in contrast, is tied to the technological curve. It thrives on the adoption of green energy and new manufacturing demand. My assumption that it would mirror gold's performance missed the exponential nature of technological S-curves. Industrial use is not linear, it compounds as new technologies scale. The problem is timing. Silver's industrial boom often lags macro cycles, creating long periods of underperformance before explosive catch-up moves. Understanding that requires more patience, more data, and less reliance on legacy correlations. The biggest mistake I made was viewing these assets as static relics rather than dynamic participants in a global monetary and technological transformation. The reality is that gold and silver now sit at the intersection of finance, technology, and geopolitics. They are no longer passive stores of value. They are active barometers of systemic change. My assumptions were anchored in history, but their reality belongs to the future. Over the past few years, gold's behavior has defied the expectations of even seasoned investors. While risk assets gyrated, liquidity shifted, and monetary regimes evolved, gold quietly climbed to historic highs. What makes this move fascinating is that it wasn't driven by retail speculation or fear-driven demand. It was engineered from the top down. Central banks, not individuals, became the largest and most consistent buyers. The game changed. I had initially assumed that gold's outperformance would require widespread retail panic or runaway inflation. But what we're seeing is something much deeper, a coordinated institutional revaluation of gold's place in the global monetary system. The world's largest central banks, those in emerging markets like China, India, Turkey, and even smaller economies diversifying from the dollar, have been accumulating gold at record pace. They're not doing it because of short-term inflation prints or yield curves. They're doing it because trust is fracturing. Sovereign reserves that were once parked in U.S. Treasuries are being reallocated to tangible assets that can't be sanctioned, frozen, or inflated away. Gold, in that context, becomes a form of geopolitical insurance. It's not just a commodity anymore, it's a statement of monetary independence. The quiet but powerful message from these institutions is, we're preparing for a world where the rules of value transfer might change. This institutional accumulation explains much of gold's resilience, even in periods when traditional indicators, like rising real yields or a strong dollar, would normally suppress it. The central bank bid has created a structural floor under gold prices. It's no longer entirely a market driven by sentiment. It's a market supported by balance sheets that operate outside speculative cycles. When central banks buy gold, they do so for decades, not quarters. That kind of time horizon fundamentally alters the supply-demand equation. Annual mine production around 3,000 tons is now being absorbed largely by official buyers, leaving less for private markets and investment flows. Another aspect that's been underestimated is how this accumulation redefines gold's correlation with risk assets. In the past, gold often acted inversely to equities or the dollar. But as central banks purchase gold regardless of cyclical trends, its price dynamics have become more detached from conventional relationships. It now trades less as a hedge and more as a parallel store of sovereign credibility. That's why we've seen gold rise even when equity markets rally, because the underlying drivers are structural, not reactive. The central bank game extends beyond physical buying. It's also about signaling. When a major nation announces gold purchases, it sends ripples through the global financial architecture. It says, in effect, we are reducing our dependence on fiat intermediaries. This quiet shift undermines the long-standing assumption that the dollar will remain unchallenged as the world's ultimate reserve. And while that transition won't happen overnight, it's already influencing how institutional investors perceive risk and security. Gold is reclaiming its role as the neutral asset in a world of politicized money. In this context, gold's outperformance is not irrational, it's inevitable. The global debt load has reached levels that constrain monetary flexibility. Every rate hike, every tightening cycle, exposes new vulnerabilities in the system. Central banks, aware of this fragility, are hedging their own policies by accumulating the one asset outside their control. It's a paradox. Those who print money are simultaneously seeking protection from its potential devaluation. That paradox is driving a silent rebalancing that markets are only beginning to price in. When I revisit my earlier assumptions, I realize I had viewed gold as a reactive asset, something that responds to crises. In reality, gold is now preemptive. It moves before the cracks become visible, reflecting the foresight of those who understand systemic risk from within. The central bank game isn't about chasing returns, it's about preserving sovereignty. And as long as that objective defines global strategy, gold's outperformance will not only persist, it will accelerate. Silver has always been the paradox of the precious metals world, part safe haven, part industrial powerhouse. It is both ancient and futuristic, a bridge between monetary tradition and technological transformation. For years I saw it mainly through one lens, a metal that would track gold with higher volatility, offering amplified gains during bull markets, but silver's identity has evolved. It's not just a mirror of gold anymore, it's a reflection of the world's shift toward electrification, clean energy, and digital infrastructure. That duality, store of value and industrial necessity, is both its greatest opportunity and its biggest risk. Silver's monetary side remains powerful. It has millennia of history as money, and it still reacts to macro variables like real yields, inflation expectations, and currency weakness. But in the last decade, the industrial demand narrative has completely redefined the market. Over 50% of global silver consumption now comes from industrial uses, primarily in solar panels, electric vehicles, and advanced electronics. The green transition has effectively tied silver's fate to the technology adoption curve. The more the world accelerates toward renewable power and electrified mobility, the more structural demand silver will see. That's an extraordinary tailwind, one that could tighten supply faster than new mines can respond. But embedded in that opportunity is an underappreciated risk. Industrial demand makes silver cyclical. When growth slows or manufacturing contracts, silver demand drops sharply. It stops behaving like a safe haven asset and starts acting like an industrial metal. That's what caught many investors off guard during global slowdowns when gold rose on safe haven flows, silver lagged or even fell. It's not because the long-term fundamentals were broken, but because short-term industrial weakness overwhelmed monetary demand. Silver's price, therefore, reflects not just macro policy, but the health of global production and innovation cycles. Another challenge is the supply side. Silver is rarely mined independently. Roughly 70% of global supply comes as a byproduct of mining for other metals like zinc, copper, and lead. That means production doesn't necessarily respond to rising prices, a dynamic that can create prolonged deficits or gluts depending on broader mining activity. We're already seeing structural deficits emerging as industrial consumption grows faster than mine output. Yet, because of its byproduct nature, supply elasticity remains constrained. This creates a setup where volatility becomes inherent. Surging demand meets inflexible supply, producing explosive rallies and painful corrections. Silver's duality also shows up in investor behavior. It attracts two completely different audiences: long-term believers in sound money and high-beta speculators looking for leverage to gold or industrial growth. These conflicting forces make silver's market psychology unstable. The same factor that makes silver so appealing, its potential to outperform, is also what makes it punishing for those with short time horizons. The swings are not noise, they are the price of participating in an asset that sits between two worlds. Yet that volatility carries value. In moments when technology adoption accelerates, like during solar manufacturing booms or EV surges, silver's industrial story dominates, and the metal can dramatically outperform expectations. It becomes a lever on the innovation cycle itself. The transition to net zero energy systems is projected to multiply solar capacity several times over this decade. Each gigawatt of solar energy requires roughly 80,000 ounces of silver, Multiply that by global targets, and the magnitude of potential demand becomes transformative. Silver isn't just a commodity in that sense, it's a building block of the future energy grid. Still, the same technology that fuels its upside could also reduce its intensity over time as manufacturers innovate toward efficiency and substitution. Silver's industrial destiny is powerful but not guaranteed. As new materials emerge and processes evolve, its dominance in certain applications could moderate. The challenge for investors is to understand where we are in that innovation curve, whether silver's industrial story is accelerating or plateauing. The opportunity, therefore, lies in the tension between these forces. Silver offers asymmetric potential in moments of synchronized macro easing and technological expansion, but it punishes complacency when growth slows or capital tightens. The balance between its role as a monetary hedge and as an industrial input will define its trajectory in the coming decade. To grasp silver's true nature is to accept that it will never behave neatly. It's not purely defensive nor purely cyclical, it's dynamic, adaptive, and unpredictable. That is precisely why, for those who can withstand its turbulence, silver remains one of the most intriguing plays on the intersection of innovation, scarcity, and systemic change. Timing has always been the silent force behind every major investment outcome. It's not just about what you own, it's about when you own it, and under what conditions the broader system is operating. In the world of gold and silver, timing is intertwined with the macro landscape in a way that most investors underestimate. These metals don't simply move because of inflation or fear. They move in response to the behavioral shifts of policymakers, markets, and participants reacting to the tides of liquidity, growth, and credibility. The interplay between these forces determines whether gold and silver soar or stagnate. When real interest rates fall, gold tends to rise. It's a simple relationship, but beneath it lies a behavioral truth. Lower real yields reflect a world where growth is slowing, where the cost of holding non-yielding assets drops, and where investors start questioning the sustainability of monetary policy. In those moments, gold doesn't act as a speculative asset. It acts as a mirror to collective doubt. But when the cycle turns, when nominal rates rise faster than inflation, or when optimism floods back into equities, the tide shifts, and capital exits the safety trade. That rhythm of fear and confidence is what drives metals over time, not single data points or headline CPI prints. Silver operates in an even more delicate balance. Its dual nature, part monetary, part industrial, means it reacts to the macro cycle with amplified intensity. When rates fall, liquidity expands and manufacturing rebounds. Silver outperforms gold because it benefits from both monetary easing and industrial resurgence. But when the economy contracts or liquidity tightens, silver's volatility turns against it. It behaves less like a store of value and more like a cyclical metal, punishing late entrants who mistake short-term weakness for long-term decline. Understanding this timing isn't about predicting the exact month or quarter, it's about recognizing where we are in the liquidity and growth cycle. Monetary policy has become the most powerful timing instrument in modern markets. Central banks have blurred the line between economic management and market intervention. Each rate cut or hike sends ripples across every asset class, including metals. But it's not just the policy itself, it's how markets perceive that policy. If investors interpret easing as a sign of weakness, gold and silver tend to rally. If they interpret it as confidence in growth, metals often lag. This behavioral dynamic explains why gold sometimes rises even in disinflationary environments, because what truly matters is not inflation itself, but trust in the institutions controlling it. Another factor that drives timing is global liquidity. We've entered an era where liquidity cycles dominate price action more than traditional fundamentals. When central banks expand balance sheets, capital flows to real assets seeking protection from debasement. When liquidity contracts, everything deflates, including metals. The behavioral layer here is crucial. Investors chase liquidity when it's abundant and fear it when it's scarce, creating exaggerated boom-bust patterns. Gold and silver don't move randomly through these cycles. They act as pressure gauges, absorbing the consequences of human overconfidence and fear. But even beyond policy and liquidity, there's the question of behavior, the psychology of crowds. Every metal's bull market in history has been amplified by emotion. Investors oscillate between indifference and euphoria. They rush in when prices break out, only to exit when volatility shakes them. That pattern repeats because gold and silver are narrative-driven assets. They thrive on conviction and collapse under doubt. Long-term success, therefore, demands the opposite of herd behavior: patience when others capitulate and restraint when enthusiasm peaks. Timing also interacts with structural macro risks: debt saturation, geopolitical shifts, and currency instability. These aren't momentary catalysts, they are slow-moving tectonic forces. They create the conditions where precious metals regain strategic importance. Yet even in these macro inflection points, behavior determines outcomes. Investors who react emotionally to headlines often miss the long-term signals that matter. The most profitable entries occur not at the moment of crisis, but in the quiet before the storm, when conviction is low and opportunity is high. Ultimately, timing in metals is less about clockwork precision and more about understanding macro psychology. Gold and silver rise not just because of inflation, but because the collective trust in monetary architecture begins to erode. They fall not just because yields rise, but because belief in stability temporarily returns. Recognizing that cycle when faith begins to fracture or when complacency peaks is what separates reaction from foresight. It's not the chart that reveals timing, it's the collective behavior driving it. In an era defined by policy extremes and shifting confidence, mastering that behavior is the true edge.